I'm going to go over QYLD in detail and tell you the pros and cons so you can make a decision whether or not QYLD is right for your portfolio. Please remember to subscribe for more videos like this and to help me grow my channel. QYLD is a Global X NASDAQ 100 covered call ETF. It is a tech investment that seeks to generate income primarily. The ETF offers a huge distribution yield deep in the double digits and makes monthly payments. Its top 10 holdings consist of Apple at 12.21%, Microsoft at 10.27%, Amazon, Tesla, Nvidia, Alphabet, which is Class C, and then Alphabet Class A. Then you have Meta Platform Inc. at 3.42%, Broadcom, and then Costco being the 10th one at 1.88%. Here we have it broken down by weighted sectors. In basic materials, we have 0%, communication services 17.53%, consumer cyclical at 16.33%, consumer defensive 5.57%, energy at 0%, financial at 1%, healthcare just over 6%, industrials 3.96%, real estate you'll notice has 0%, technology is the biggest sector with 48.29%, and utilities just over 1%. Here we have the geographic breakdown. You'll notice that the United States makes up 97.6%, as well as some smaller amounts in the United Kingdom, Latin America, Eurozone, and Asia emerging. QYLD is an exchange-traded fund that seeks to replicate the performance of the CBOE NASDAQ 100 Buy-Right V2 index. That is a mouthful, but essentially this is an index that tracks the performance of a theoretical portfolio that invests in the NASDAQ 100 companies and that sells covered calls on these equities. Covered call selling generates income, which varies over time to some degree, through the option premiums that the seller of the call option receives. Selling covered calls is thus a strategy that can also make sense for income investors for their own personal portfolios. With QYLD replicating the performance of the CBOE NASDAQ 100 Buy-Right V2 index, investors more or less get the same performance as the underlying index generates. Due to the fact that the index and the ETF utilize 1 month at-the-money options for their strategy, the received premiums are relatively high on average. This translates into a high dividend yield for QYLD. Let's go over QYLD dividend metrics. After all, that's why a lot of investors are attracted to this. QYLD has made monthly distributions since it was created in 2013. Now, these distributions vary in size, which can be explained by the fact that QYLD's cash flow that it generates through selling options is not fixed at a certain level. Instead, option premiums received over time depend on factors such as the underlying volatility of equity markets, which is why distributions can be higher or lower at times. We see here that distributions were not even over time. Instead, there were some ups and downs throughout 2021, with the year-end distribution in December being the highest by far. The 12-month distribution yield, calculated as distributions received over the last 12 months versus the most recent net asset value, is quite high at 14%. There is no guarantee that the fund's yield will remain this high in the future, as lower volatility in equity markets will likely head and lead into the lower option premiums received, and therefore would result in lower distributions from QYLD. Still, QYLD has a history of offering quite sizable income to its owners. So why has QYLD dropped in 2022? Well, QYLD, as an ETF that is tied to the NASDAQ index, has dropped sharply in 2022. The ETF is down by 11% so far this year, with the drop occurring alongside the broad market's drop over the same time. Worries about macro risks such as the current Russia-Ukraine escalation and looming rate hikes in the U.S. are responsible for the sell-offs across equity markets. Tech stocks, due to their growthy nature, are especially vulnerable to higher rates that lead to higher discounted rates, which explains why tech generally has underperformed commodities, consumer staples, etc. QYLD's price tracks its net asset value very closely. We can thus say that the recent price declines have been justified or reasonable. The underlying assets that the fund owns have become less valuable during the tech sell-off, and QYLD's share price reflects that declining value. So after all this, is QYLD a good choice for dividend portfolios? Well, the distributions that QYLD has made in the past are very enticing. Investors get a yield this high almost nowhere else, and the fact that payments are made monthly is an added bonus. Investors get a lot of income that is distributed to them very evenly. Before jumping into QYLD, though, investors should consider some other things, however. First, income may be important, but it's not everything. Underlying asset value and price performance have to be considered as well, and QYLD does not look too good on that side. Since its inception a little more than 8 years ago, QYLD has seen its net asset value drop by around 20%. At the end of 2021, the performance looked better, but even then, net asset value had declined by around 10% since its inception. That's not utterly destructive, and the income received since 2013 more than makes up for the NAV loss. But still, it seems pretty clear that investing in QYLD is not allowing for an upside anywhere close to what an investment in, let's say, the NASDAQ index itself, or QQQ, would have resulted in. Looking at QYLD's expenses, we see that it's not a cheap ETF. The total expense ratio, which you really have to take into consideration per its fact sheet, is 0.6%. QQQ, which is a NASDAQ for a comparison, has a total expense ratio of just 0.2%. And that really starts to add up, or just one third of what QYLD investors are paying to the ETF managers. QYLD has offered very sizable distributions every year in the past, even during times when markets went sideways or declined. That's a good thing, of course, and makes bear markets more bearable. The ETF also hasn't been especially volatile, as its annualized volatility of around 15% is considerably lower than that of the Nasdaq 100 at 20%. For someone looking for relatively reliable income generation, a sizable yield, and below average volatility, QYLD thus could have some merit. The ETF strategy generates huge income, but no capital appreciation even under favorable circumstances such as a huge tech bull market. Now, I've given you a lot of information, but hopefully you can make an informed decision whether or not QYLD is right for your portfolio. Don't forget to subscribe to help me grow my channel for more videos like this.